At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at goldsilver.com.
So, the next chart here, chart number 9, you've got the US dollar index. So this is the inflation that we are experiencing against the economy, I guess. You've got the US dollar index, gold, Bloomberg Gold Aggregated Bond, Global Aggregated Bond Index. So that's bonds. What is MSCI ACWI? I don't know what that is.
That's the MSCI all countries. I think the weighted index. So that's basically a global equity index.
Okay.
And it basically shows us that risk assets have a hard time this year. Obviously, gold started really well into this year, almost made new all-time highs in March in US dollar terms. But then I think the market started really believing the narrative that Jay Powell is the new Paul Volcker. I recently said in an interview, if Jay Powell is Paul Volcker, then Danny DeVito is Brad Pitt. So I don't really see that, but the market believes in this narrative that we'll go to 3.5% interest rates next year and very aggressive tapering or quantitative tightening. Actually, I don't really see it, but I think starting in April that did really hurt the price of gold. And what's really interesting, Mike, is we had a look at the long-term data again. We, like you, we really like long-term charts to understand the big picture. And actually, in the last 90 years, there were only 4 years when bonds and equities had a negative performance. And since the beginning of the year, both bonds and equities are down significantly. So we could see the 5th year out of the last 90 years where bonds and equities show a negative performance. And in all those previous instances, inflation was always a big topic. So it tells you clearly that as soon as inflation rates leave this kind of feel-good zone above 3.5%, then not only bonds but also equities have a hard time. So I always, for us as asset managers, it's totally fine to accept the challenge, but it's like I always make the comparison. It's like with skiing. When you've got fresh snow and great weather, everybody is a good skier, even our friends from the Netherlands. But if it's icy, if it's foggy, if it's really tough conditions, then you can really differentiate who's really a good skier and who's not. So I think this environment, the opposite to last year where it was really easy to make money in financial markets, this year is really telling you, well, you have to be a pretty good asset manager to navigate your clients' money through those markets. And I think, this is a strong case for gold again. It's a strong case for a portfolio diversifier. It's a strong case for commodities as well. But unfortunately, still most people don't have any allocation in commodities, and also obviously not in gold. But this is going to change.
Yeah. It's interesting how most investors, they chase price instead of using a pullback or the general public's disinterest in something to pick up bargains. During the pandemic plunge, when the pandemic first broke out and they shut down the economies, the prices of gold and silver just fell off a cliff for a few days. I was able to pick up some silver during that dip. And it was, the performance that I've had on that since then is phenomenal. And so, the average investor needs to learn to have a little bit of capital set aside and then to go against their emotions, to analyze things and use things like, you guys are doing some great analysis work. You've got a big team putting together a whole lot of research, doing some great analysis work, and then publishing this stuff. And for me personally, I just see the next few years as precious metals are like the place to be. So what's the next chart you'd like to show us?
Well, we could have a look at slide number 10, which is showing the ECB's balance sheet and the price of gold in euro terms. And actually, I don't want to praise the Federal Reserve, but on a relative basis, I think the Jay Powell did a much better job than Christine Lagarde over here in Frankfurt at the ECB. And you can see that the balance sheet of the ECB, which was marketed when the euro was introduced to be like similar to the German Bundesbank, you can see this very, very aggressive monetary policy and this very dovish monetary policy. And it's no coincidence, obviously, that the price of gold in euro terms is doing so well. So actually, Christine Lagarde, she kept pretending that inflation is also only transitory. I think in spring she said that inflation is like a hump. Yeah, it doesn't really look like a hump. It looks like the Kilimanjaro or the Mount Everest at the moment. But only now they start communicating some tightening. And obviously they're quick to blame everyone, especially Russia. But I think we should be honest and say that inflation rates were already rising big time before the Russian invasion in Ukraine.
Yes.
We should say that energy prices were already up before that. So just saying, okay, this is I think Biden said it's the Putin price hike. Well, Edward Bernays would be very proud of him, but that's just obviously it's not true. The root cause obviously is very, very aggressive fiscal and also monetary stimulus in the process of the whole Corona crisis. They should have hiked or should have taken away the punch ball much earlier. We know that, but it hasn't happened.
I don't know if you saw just recently, a couple of days ago, there was a conference and somebody asked Christine Lagarde, how will the ECB bring down its balance sheet? How will they reverse all of this? And she says it'll happen in due course. And they go, but how? How are you going to do it? In due course. She was caught like a deer in the headlights. She does not have an answer of how they're going to do it. When you look at this graph here, this chart, on the right-hand scale, it starts at 0 and goes up to 9. And if you look across, it was actually below 1,000 back in 2002 and 4, and hit about 1,000 in probably 2006. And now it's up at 9. So it's a 9 times increase in the currency supply. And, we call it fiscal policy and monetary policy. And, this is monetary policy. But we give it these fancy terms, quantitative easing. This is counterfeiting currency into existence, diluting the currency supply, and stealing wealth from anybody that's holding currency and bestowing wealth on anybody that derives their net worth from their stock portfolios or wherever that currency is spent first. It's usually in the financial markets. And that blue, they don't measure financial markets and assets such as real estate as part of inflation. They're measuring just certain things. So there has been inflation during this entire time that they've been inflating the currency supply. It's just, the Cantillon effect. It's inflation that is very specific to wherever that currency is being spent first. And so, yeah, this is an amazing chart. The ECB, like all the rest of the world's central banks, is out of control. And I believe that these Keynesians that are running things are very, very dangerous, that they're going to cause an enormous crash.